Today, we're diving into the fast-paced world of cryptocurrency with a crucial guide you can't afford to miss, especially if you like keeping your money where it belongs, in your wallet. So, buckle up, because we're about to speed through 30 ways to lose all your money in crypto in just 7 minutes. Cryptocurrency can be an exciting investment frontier. It's been hailed as the future of money, but it's also a landmine-laden field that can blow up your bank account if you're not careful. Whether you're new to the crypto space or you've been here for a while, avoiding these pitfalls is key to keeping your digital treasure safe. Before we rocket through these traps, let's get a couple of things straight. Investing in crypto is not for the faint of heart, and it's definitely not a guaranteed way to get rich quick. It's volatile, it's unpredictable, and as we're about to see, it's incredibly easy to make mistakes that can cost you big. Ready? Time is ticking. Let's go. Failing to do your homework. Jumping into an investment without understanding what you're buying is like skydiving without a parachute. Cryptocurrencies aren't just about hype, they're complex assets based on blockchain technology. Not doing your research can lead you straight into a pitfall. Getting caught in FOMO, the fear of missing out. It's that burning urge to buy crypto because everyone else is doing it and you hear it's skyrocketing. But guess what? FOMO buys often happen at peak prices, and the fall can be just as swift as the rise. Ignoring security measures. If your crypto wallet is as easy to hack as your old MySpace account, you're in trouble. Using weak passwords and ignoring two-factor authentication are invitations to hackers. Secure your digital wallet, like you would do with a treasure chest. Investing more than you can afford to lose. This is a golden rule in all types of investing, but it's especially true in crypto. The market is volatile, and while the highs can be exhilarating, the lows can be devastating. Only invest what you can realistically live without. Spreading yourself too thin. Investing in too many cryptocurrencies can dilute your focus and complicate your strategy. Keep your portfolio manageable. Neglecting portfolio diversification. You've heard the saying, don't put all your eggs in one basket, right? Well, in the world of crypto, that couldn't be truer. Trading based on emotion. Let's be real, the crypto market can be a roller coaster of emotions. But making trading decisions based on how you feel rather than the data, that's a recipe for disaster. Whether it's panic selling or greedy buying, emotional trading often leads to poor decisions. Using too much leverage. Leverage can magnify your gains, but it can also wipe out your investments just as quickly. If the market moves against you, high leverage can lead to high losses. Handle with care. Neglecting market signals. In crypto, it's crucial to stay informed. Ignoring significant market signals and trends can leave you unprepared for major movements. Always stay updated and be ready to adapt to new information. Setting unrealistic expectations. Hoping to turn a quick profit or expecting consistent high returns sets you up for disappointment. Crypto isn't a get-rich-quick scheme. It requires patience and realistic goals. Investing based on hype. It's easy to get swept up in the buzz around new projects promising the moon. But investing without a solid understanding of the project's fundamentals is like building a house on sand. Do your due diligence. Ignoring security updates. In the world of crypto, security is paramount. Failing to update your software can expose you to vulnerabilities. Keep everything patched and up to date. Keeping all your crypto in one place. Diversify where you store your crypto to mitigate risks. Using multiple wallets can protect you if one is compromised. Falling for scams and phishing attacks. Scammers are getting smarter. Always verify before you click or share personal information. If it sounds too good to be true, it probably is. Ignoring investment fundamentals. Crypto is not exempt from traditional investment principles. Understand market cycles, do not overextend, and maintain a balanced portfolio. Lacking an exit strategy. Know when and how you'll exit your investments before you enter them. Set your targets and stick to them. Not using stop-loss orders. This is a tool that can be a game changer for managing investment risks. Stop-loss orders are like setting an automatic safety net for your trades. You decide the price at which your crypto should be sold to prevent further losses if the market takes a sudden dive. Neglecting technical and fundamental analysis. Skipping the homework on technical data and market fundamentals means missing out on critical insights. Use the tools at your disposal to make informed decisions. Overconfidence in personal knowledge. Believing you can outsmart the market without sufficient experience or expertise can lead to risky decisions. Stay humble and keep learning. Ignoring contrarian views. It's easy to stay in an echo chamber, But hearing only what you want can blind you to real risks. Listen to diverse opinions to broaden your understanding. Short-term trading without a plan. Quick flips can be tempting, but without a clear strategy, they're just gambles. Define your short-term trading goals and rules. Lack of adaptability. The crypto market evolves rapidly. Sticking rigidly to one strategy without adapting to new data can lead to losses. Be flexible. Inattention to detail. Missing important information in a white paper or misunderstanding a fee structure can have significant consequences. Pay attention to the fine print. Failure to recognize a bad investment. Holding on to a losing crypto because of emotional attachment or hope for a rebound is costly. Know when to cut your losses. Neglecting continued education. Crypto is a field where new developments happen daily. Failing to keep up to date can leave you behind. Always keep learning. Investing in unverified projects. Jumping into ICOs or new tokens without thorough vetting can lead to scams. Research the team, the technology, and the market viability. Relying on hot tips from unreliable sources. Taking investment advice from social media or unverified tips can lead to disastrous decisions. Trust, but verify. Overlooking fees. Every trade, every transaction comes with its cost. High fees can eat into your profits faster than you can say blockchain. Always check the fee structure on your exchange or wallet. Those little percentages add up. Ignoring taxes. Yes, even digital currencies are taxed. Not planning for tax liabilities can lead to unpleasant surprises come tax season. Keep track of your transactions and report them correctly to avoid potential fines. Ignoring liquidity. Investing in cryptocurrencies that have low liquidity can trap your funds when you need to exit. Check the trading volume before investing. And there you have it, 30 fast-fire ways to lose your money in crypto. Remember, the key to successful crypto investing is caution, research, and ongoing education. Stay safe out there. Thanks for watching. If you found this video helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe for more insightful content. Drop a comment below with any questions or what you'd like to see next. Until next time, keep your crypto secure and your investments sound.